Good morning, everyone, and welcome to the Sirius Report. As always, it's Ken and Paul here once again, and we've got a very interesting topic we haven't talked about in a little bit. And the reason why it's interesting is because it seems like we may finally be reaching that point that, Paul, you have mentioned for many, many years that gold and silver will not truly have their breakout until the physical metal is drained from the West. And we've got more and more indications that are showing that to be true. Paul, as always, want to thank you for being a part of this discussion. And we got a lot really to talk about this topic.
Yes, and obviously likewise, Ken. Pleased as ever we can get together. Yeah, just to make the point you made, I first said this. I mean, this was before I was on, well, Twitter as it was when I had a YouTube channel. We didn't do podcasts. This was more in a professional capacity. And because I used to work quite heavily in gold, silver markets, in mining and other commodities. And I made the point when someone said to me, what do you think is the breakout point for gold and silver? And I always said it'll only happen when the West is drained of gold and silver. Now we have to be careful what we mean by that. And what I mean by that is it's available gold. It doesn't mean there's no gold or silver full stop in the West, of course. That would be nonsense to suggest that. But it's where the demand far outstrips the supply, and therefore it would iron out the enormous problems we've had with paper markets, where it's very difficult to ascertain what the ratio truly is between paper gold and physical gold, and paper gold, paper silver, and physical silver. Now, the question is, are we actually definitively at this point now? Well, what we can say, we are seeing evidence currently of stresses in the physical markets in the West for both gold and silver, and we'll explain in detail why. Is that going to be the case going forward? Possibly. I mean, I think anyone who's trying to talk with confidence that this is the case and definitively, and this is, the straw that's broken finally the camel's back, so to speak, and we're in a whole new world in terms of the pricing of gold and silver. Can't say that with absolute certainty. You can have some degree of confidence or belief, but let's see what happens in the coming 1, 2, 3, 4 months, maybe 6 months. If it continues to be sustainable in that sense, then I think you can then be confident that there has been this huge, what you might term, paradigm shift in gold and silver markets in the West. We're not talking here about what's going on in the East, just talking about what's happening in the West, because the West is effectively isn't dictating the price for gold and silver, but the West has largely been, for decades, the markets which controlled the price, just because they controlled gold and silver in sheer volume terms. That's changed markedly in recent years. There's many more markets around the world now. For example, obviously in Shanghai, Dubai's obvious examples. I think Dubai now is responsible for about 23, 24% of the whole global gold market, just to give you an example. So the shift has moved away from traditional markets. So therefore that puts additional strain on those markets to manage that clearly in imbalance between paper and physical. So I thought before we get into some of the sort of detail and things we've observed in recent years before what we're currently seeing, it was worth making that point, Ken.
Absolutely. And, one of the things that obviously the West has for decades, pretty much since the COMEX and the commodities exchange has and the futures market have been implemented in the 70s after the gold window was closed by Nixon. There's four different segments that very few people realize and understand. It does get complex, but it's what it has allowed the LBMA and the COMEX to be able to, I don't want to use the word manipulate, but control prices to some great extent through the contracts that they do. There's eligible, registered, delivered, and then removed. And in the first three cases, eligible, registered, and delivered, delivery does not necessarily mean it leaves the COMEX or it leaves the Royal Mint in London. It just means that it has been purchased and set aside, designated for whatever entity bought it. But unfortunately, since the gold is there, the COMEX and LBMA have been able to utilize that stored gold, even though it's designated somebody else, to then sell contracts or leases on that gold itself, thus being able to control and deal with the price. It's only when it's completely removed that it can no longer be used as collateral for selling their paper contracts. And it's that fourth one, that removal, that really appears to be taking place. And this is one of the big reasons why, going back to, I think you mentioned since October 2023, the price in dollars has gone up $1,000 just in that amount of time. We already have new all-time highs in against the Canadian loonie, against many of the European currencies, especially the euro, the Japanese yen, primarily because the removal has seen this shift through Switzerland, through Dubai, whatever, to the east, and it's come out of the actual vaults. So it's that removal that has seen the prices spike, and now all of a sudden, the question that is being raised is how much physical metal is still in that vaults that are part of that eligible, registered, and deliverable. How much of that remains that they can be able to do these contracts? Because if the physical metal is out of the vaults, then they will be in vast illegality to even issue contracts regarding that.
Yeah, if that's indeed the case, absolutely. But a couple of points worth making. When the Fed raised interest rates, there was an expectation, if you look at tips and what the prediction based on that was for gold, there was expected to see a gold price of $1,200 an ounce, and it failed spectacularly. The lowest, if you look back to October 2023, gold hit just over $1,800 an ounce. As you said, Ken, it's gone up $1,000 since then. In fact, it's over, because I think when I last looked, it was 28.30. Anyway, it doesn't matter because it fluctuates all the time. But in that period of time, gold has risen against the dollar over 55%. The DXY, I don't hold much credence to what it is, because basically it's so heavily weighted, it's really, to all intents and purposes, the dollar euro pair. But that has risen 1.2% in that period of time. In fact, it's probably a bit less when I put that post on X. But you get the point, essentially, it's flatlined. So this is one of these situations where there wasn't this expectation that gold would take off the way it is. Now, that is in part because of the enormous buying that's going on in the East, not just China, but also, obviously, places like India and Singapore and a whole raft of countries, even in Europe, the Stan republics, the list goes on and on, other countries in Southeast Asia. And that has put additional strain on the markets in the West. And there's a lot of people who seem to think it's a recent phenomenon whereby China's buying gold. Well, I can tell you categorically, and I've said this before, and I'm the only person who's ever made this point, is back in 2012 for 30 consecutive months, 1,000 metric tons per month went from the West to China and Hong Kong. That's 30,000 tons in 2.5 years. And this comes back to this point. There are transparent markets, all the data you see, which is a drop in the ocean compared to the opaque markets where the real tonnage swaps hands. You'll never see that data. Most people don't know who is trading that data. Fortuitously for people listening, I do. And therefore, on that basis, we can give you a clearer insight as to what is happening in the markets that truly matter. And that also has been clearly quite buoyant in that period for over a decade now, which is why I made the point in 2013 that when the West is drained of gold and silver, then you'll see true price discovery. Until then, it becomes meaningless. The amount of times I've heard people say, oh, there's a breakout happening. And I've always said there is no breakout, because at that point, there was no evidence to support the view that what we're seeing currently was happening. In which case, yeah, you'll just get periods where the price will ebb and flow, and then at some point it'll get smashed down again. And not necessarily because of market manipulation. It gets smashed down because people go, well, I've made 20% or 10%, I'm out. Well, there's people now clearly who've made 55%, maybe, if they, well, that's assuming they bought at $1,800 an ounce. I'm not saying they did, and they're not selling out. And the other point that's worth making is, no disrespect, because I would include myself as a retail buyer, retail markets for gold and silver are irrelevant. They don't matter, because how much we buy is a drop in the ocean as well. So if you think your bullion dealer isn't selling any, it doesn't matter. It's not in any way, shape, or form influencing and affecting the price. And, what affects the price is the big guns buying it. So sovereign nation, industrial players for silver is another example. India and China in recent years have bought enormous amounts of silver. And obviously institutional buyers, but there is clearly no institutional interest. I think maybe there is now in the West, but there hasn't been for a long time. The major institutional interest lies in the East. So these are important points to assess why we are where we are, what's currently happening, what's going on. And I'll stop there, Ken, because obviously you can come in and discuss this point as well.
Yeah, one of the things that you've mentioned in the past, and especially we try to hold to, is not making predictions of timing. Is this going to happen in X months or XX years, etc., but more looking at events. Events really shape outcomes. And I've been thinking more and more and seeing a lot of parallels to 1980, 1981. That, of course, was the last time that gold and silver had their big rush up. And it was primarily due to the ramifications of the stagflation of the 70s, which was a ramification or a consequence of removing gold from the Bretton Woods, from the gold window and the dollar. Less and less countries had trust in the dollar. We had the oil crisis of 1973, and et cetera. Well, one of the things, of course, like I said, we had stagflation going into the 1980s. Really, we are in recession. Europe's in recession in most of the Eurozone. The US is in recession if you really look at the data, not what's put out by the government to try to prop up the political regime. But at that time, we also had interest rates that could not keep up with the rate of inflation. Well, the one big difference that I'm looking at in what at least the new Trump administration wants to do is they want to do exactly the opposite of what Volcker had to do, which inevitably brought down the price of gold and strengthened the dollar. And then, of course, is he wants rates to go lower, more towards ZERP, rather than having to go higher to deal with inflation and, of course, then protect the dollar. But the other thing that he wants is he wants foreign investment into the United States. He's going to desperately need that from China. He's going to need that from Europe. He's going to need that from all these other places. Perhaps that's what part ways the big tariff battle and trade war is all about. But with that being said, if he ends up getting the Fed to do the opposite, and we have accelerating inflation while we have lower interest rates, that is going to take gold and silver to the moon, just like it did from about 76, 77 to 1980. So I think we are starting to see some of that cracks go through because right now the 10-year is above the Fed funds rate. So the Fed is control over rates when it comes to inflation. And at a time when we're in recession, we're at a national debt that's at $36 trillion. We have all these things that are coming to a head. And while Trump and a number of others are pushing cryptocurrencies as the savior of this thing, the reality is that central banks and most of the sovereign countries that have not bought into cryptos as something to use as a reserve, they're seeing the opportunity to get gold and silver, and I think a lot of it's flowing eastward as fast as they can click the button on their keyboards.
Yeah, and this also, yeah, absolutely. And this ties in with the fact all that we know that China has not only been buying silver, physical silver, but it's been buying silver concentrate in enormous quantity, which therefore also deprives the market of that, obviously ending up as physical silver. So they're effectively being controlling to a large extent those two markets. The same applies to gold going to China. China had this spell and everyone went, they're not buying gold. China's always buying gold. Again, in opaque markets, when they decide to tell the world they're buying gold, it's to send a signal. And the question, I think, fundamentally comes down to this point in the last few years is the dollar has lost control in terms of its ability to control inflation. They raising interest rates has done nothing. Raising interest rates has not made the dollar stronger. It should have weakened gold, and it hasn't. So, in essence, this is part of this shift away from US Treasury, which have always been this safe haven for decades, to a situation where it's no longer regarded as a safe haven because of all the weaponization of the dollar. And gold increasingly, not for everyone, and certainly not in the United States. We're seeing evidence that institutions, sovereign states regard gold as a reserve asset increasingly, which is why also it's worth noting that the United States used to dominate and dictate oil prices. That's long gone. Oil prices are now dictated by OPEC Plus, which basically means Saudi Arabia and Russia. And notice when Trump was trying to telling OPEC to smash oil prices, produce more oil, and they turned around and went, no, we're not doing it. Because they're looking after their own interests. They don't care what the United States thinks or says. And that is a big shift as well, because there's always been this tie-up, the whole days of the petrodollar, they're long gone. The US doesn't have control over those markets. And that's why, for me, observing things over a period of time, understanding what's happening in terms of the demise of unipolarity, understanding the ongoing rise of multipolarity, that we would always come to this point. And you're absolutely right, Ken. It's not time-driven. None of this is time-driven. It's event-driven. It's what I've used this term event-driven scenario, which drives people mad because they hate it. But it's reality. It's driven by a whole bunch of factors and situations. And then at some point in the future, you then get a situation where the market changes. Now, I think in the last 2 years or so, we've seen quite a lot of evidence to support there was this change happening because, as I've said, and you mentioned as well, Ken, that gold's gone up $1,000 an ounce since October 2023. I mean, it's not even it's not even 18 months yet. That is quite staggering given all the other developments we're seeing. So these are all factors that are ongoing. They seem to be consistent with this broader idea of this big event-driven scenario change. Now, we're seeing something. It's early days because these things don't happen in the blink of an eye. And I think, Ken, that's probably a good point to stop with this first sort of podcast on this subject to do with gold and silver. I don't know whether you want to add anything, of course, before we end this, but I think with the next one, we can go into the nuts and bolts of what's actually we're witnessing at the moment and why it supports the evidence that this event-driven scenario could be on the cusp of making this big change, although, as I said, could, not saying it definitively it is.
Absolutely. And we didn't get a chance to talk about the current headline news about tariffs are causing this, but that's something we're going to go
Well, that's
to
in the
into
second
it.
part. Yeah.
Yeah, exactly, in the second part. So, everybody, we're going to go ahead and make a part two of this, but want to thank you always, Paul, for your insight and for being a part of the discussion.
Yes, and obviously thank you as well, Ken. And just small point here, given what we're discussing, this is not investment advice. It's purely for educational purposes. We're not telling people to buy and sell gold or silver or enter the market or leave the market. It's purely to give people some factual background as to what we're witnessing. So I know people say, why do you do this? Because we have to, because we're not here to give investment advice. And this most certainly is not that. So I just wanted to add that point as well.
Absolutely. And to everybody here at the Sirius Report community, thank you for all of your support. Don't forget to like, share, subscribe, comment, send this out to anybody you think it'd be important. And until the next time we get together with part two, have a great day.